What Lonnie just shared was code for Elon's just trying to do things that benefit Elon.
And it's not just Elon and Twitter, but if you look at all these major tech companies have all slashed their real estate footprints. Millions of square feet of leases at $60, $80 a square foot. That adds up really, really quick in terms of how that affects your bottom line.
We got Lonnie Hendry. He's 1/3 of the podcast Treppwire.
He just gave us a massive amount of context on what's going on in the commercial real estate market.
His expertise is really in the CMBS commercial market, commercial mortgage-backed security loans. He specializes in valuation, appraisals, analytics, modeling, and financial analysis.
He even shared with us a little bit about Elon Musk and what he's dealing with right now with his purchase of Twitter.
He offers me a job. He offered me a job.
But he did a great job quizzing you at the end.
But right now, I feel like the Happy Gilmore of commercial real estate.
Man, you seem to be striping it right down the fairway.
My daughter's name is Birdie, so. This is Bo Barron, CCIM.
And this is Timmy Barron, ADHD.
He's going to teach me about commercial real estate. Stick around to the end because we are doing a pop quiz. Can you beat me? Bet you can.
I just went all ADHD on you.
Say this is commercially speaking, Bo.
And this is commercially speaking.
Yes.
Especially with the world doing what it's doing right now, we thought you'd be a great guest to have on here. So thanks for taking the time. We really appreciate it.
Yeah, I look forward to it. Excited. Thank you.
This is my brother, Timmy. Timmy, this is Lonnie.
Hey, Lonnie.
Timmy, when it comes to commercial real estate, he's an idiot. So we have to use small words when we're communicating with him. So I may stop you quite a bit. He may stop you and just ask for, like, man, we need a 5th grade explanation of what you're talking about. But that's sort of the purpose of our podcast.
Sure.
Is for me to teach Timmy commercial real estate in a way that's plain to understand. So
good luck.
Yeah. We're going to quiz Timmy at the end. Based on what
I'm ready. I like it.
So just be thinking about a couple questions.
Oh, yeah. I mean, I'm a college professor on the side. So, like, I'm all about it. Like, we'll have a full-on written exam if we need to. No chat GPT either.
Okay.
With that context, man, but why don't you teach us something about CMBS and, like, literally, what does CMBS stand for? What's it mean? Like, what is this thing that provides a tremendous amount of liquidity? And you're going to have to explain liquidity.
CMBS is commercial mortgage-backed security is what it stands for. And effectively what that means is that a bond is created with a pool, like multiple loans, and that bond gets sold on the secondary mortgage market. And it provides access to more capital for lenders to make new loans. And the benefit is that, it keeps the commercial real estate capital markets or lending markets open for business in ways that they otherwise wouldn't be able to. CMBS was born out of the savings and loans crisis in the late 1980s. So if you guys were in the CRE business, or if Timmy was, not wanting to learn about the commercial real estate at that point in the late 80s, the savings and loans had started making commercial mortgage loans, and they went under. They made bad loans. There was a lot of stuff that led to that.
Okay, let me stop you real quick. What's a savings and loan? Because Timmy was born in the late 80s.
Okay.
So
yeah. So it was a lending institution. So it's kind of like credit unions or banks. They typically did not make commercial property loans, and they started making commercial property loans or speculative development loans, so like new construction, and they flipped a bunch of those, and some of the projects didn't make, and so what we ended up with was like this really big set of toxic assets. And so the government actually had to step in, and they created this facility called the Resolution Trust Corporation, or the RTC, and they bought up these toxic assets, and then they started selling them off. And so when the government bought these assets and started bundling them together, that was kind of the precursor for this pooling of assets type of model. So this really was born out of the late 1980s crash. It became like a viable investment vehicle in the early 90s. And here we are in the mid 2020s, and CMBS is a pretty, large component, probably 15 to 25% of the overall debt market on the CRE side. So it's become a mainstay of commercial real estate financing.
Okay, so let me break this down a little bit. One of the first things you just said was that CMBS, it's essentially a bond. Is that correct?
Yeah. So like it's a pool of loans. So you might be 40, 50, 60 loans or properties that take out a mortgage on the property. And then the lender then pools all those together, creates a bond that they then sell off in tranches. That's a cool word.
Yeah.
To bond investors, right? And so basically you get, as an investor, you can buy certain tranches or effectively slices of that bond with different risk premiums. And then, that creates that additional liquidity in the marketplace because they pool those assets together, they sell them off on the market, bond investors, in exchange for buying the bond, get the interest payments on the mortgage repayment. And when everyone, makes their payments, everyone gets paid interest, everyone's happy, everything's great. In, disruptive times like we're facing right now, it becomes a little suspect sometimes because some properties don't make the mortgage payment. And then the people holding those bonds potentially lose money.
Okay. So let's say I put a group investment deal together, a syndication, and we go out and buy a property. And to pull that deal off, I go to some local bank and we get traditional financing. That bank just gave me a couple $1 million or whatever, and now I owe that bank back. So it has lost the ability to use those dollars for any other loans. So they take my deal or that mortgage and 30 others like it, pool it together and create a CMBS bond, essentially, sell that out to investors who want a piece of that bond and they want to participate in the interests. And then the bank in return basically gets their money back from selling the bond. Is that correct?
That's it. And that's where the liquidity increase comes in. If they weren't able to offload that initial loan that they made to you, they wouldn't have the capital available to make new loans. And so the process was designed really to create liquidity in the marketplace, which, as we saw coming out of the great financial crisis in 2008, the one thing that can really stymie the commercial real estate marketplace is a lack of available funding. Commercial properties generally are not traded for cash. They need a lifeline of credit or liquidity to be able to buy and sell. And if that dries up, then the whole market really falls apart. And so this really provides a very large component of what's a healthy commercial real estate landscape. And so that's what, if you're looking at the current environment, what's a little bit scary is if banks start reducing their lending capacity, or if the bond buyers, stop having an appetite to buy these securitized pools of loans, that liquidity dries up and that leads to less transactions, less market data. People don't know what the true value of an asset is. And so we're kind of on the front end of that right now.
Let me say what I understand back right now. Okay. Out of all this, I need money from the bank. So I take out a loan from the bank. The bank gives me that money and they are going to make money off of me through interest payments. However, they need that money to give to other people. So an investor comes and buys but that loan, they can accrue that interest. And now as the bank, I've got money to lend to more people. And so where we're at right now is the appetite for buying these loans are lowering because the interest rates are going up. Not as many transactions are happening, which means cash flow is lower. And if you want to kill a business, to private cash.
I'm not sure what ADHD means in the commercial real estate field, but I think you're farther along in your progression than you're letting on.
A part of that is the ability to hyper focus. And when you're talking, Lonnie, I'm really into it.
I love it. I love it.
A lot of times when I'm talking, he gets that ADHD look on his face where he starts nodding his head, but he's thinking about Cheerios or Tweety Bird or something like that.
Or Alec Baldwin. That's it. It's going to happen. It's going to happen. Okay, cool.
Are we getting a sponsorship for that product placement right there?
Alec Baldwin product?
No, I was talking about whatever you were just drinking.
Yeah, the Walgreens LaCroix brand. Oh, there we go. That's kosher. All right, so we're on the front end of the appetites lowering. What can we look forward to here?
Yeah, so I think a lot of this is the mercy of the Fed right now. So if the Federal Reserve continues to push interest rates up because they're trying to cool the economy, they feel like inflation is too high, unemployment is too low, the economy is too hot right now. They're trying to slow some of these things we've talked about. They don't want such an active marketplace. They want things to come back to, the mean, basically. They're trying to target 2% inflation. We peaked at about 10. We're down to, 5. They still have some work to do. So if they hold steady on rates or increase rates, it just makes pricing these CMBS deals very difficult because the lenders don't have enough spread to make money on the deals, and the bond investors can't really make money on the deals. And so, if this continues, we're going to see a continued decline in issuance, and that issuance decline is going to lead to just less transaction activity, less data points in the marketplace. And so just to give you guys some perspective, like if we look at the first quarter of 2022 on the CMBS side, there was about $28 billion worth of issuance. And if you look at 2023, we're somewhere, I think we're about $5 billion in issuance. So it's a dramatic slowdown. So when I say on the front end, this could get pretty ugly pretty quick if the market conditions from the Fed's perspective and just transaction from participants doesn't start to pick up.
Now, let me ask you this. Are they lending and getting stuck with it and not being able to offload to the CMBS market and regain that liquidity, or are they just not lending?
Yeah, it's kind of a combination of both. To get a deal through the diligence process to where a lender can give a firm commitment, there's a lot less property making it to that phase than there was before. And even when they do, to your point, like once they have the ability to collateralize this and sell it as a bond, there's just a way smaller appetite on the bond investor side because the spreads are not there for them to make money on this. And so at each level, things are slow. If you look at an income and expense statement and you say, well, occupancy is up 2%, but then each of your line item expenses are up 1%. Well, each of those independently don't kill your NOI, but in sum total, it can really impact the value negatively. And that's kind of where we're at in the lending cycle.
All right, wait, I have a question for Timmy.
Yeah.
Lonnie just said NOI. What is NOI?
Net operating income.
Oh yeah, boom. Yeah, boy, there we go.
All right, this is working.
Oh, I got a couple questions. Number one, why is the Fed the Fed is doing this to help lower inflation, but it's also hurting those that are making the deals that the government also incentivizes to make those deals, which ultimately help the economy all around. It just seems like whatever's happening is kind of working against each other. And then number two, how do we fix it? How do we fix this?
It's a very tightrope type of effort that the Fed has to try to pull off here. But they don't have any tools at their disposal other than raising the federal funds rate or what, the interest rates are. So you're basically asking them to do something that's very nuanced with just a blunt instrument. And so I think what we're seeing is the markets are starting to push back. If you've watched CNBC or listened to, Bloomberg or read anything in the Wall Street Journal, a lot of property investors are saying that no.
That's okay. A no. Yeah.
Yeah.
That's a no for you, Bo? Or do you look at that stuff, don't you?
I pay some attention to that, but we're talking about you, Timmy.
Yeah, no, yeah.
So I can send some links out after the pod, Tim, and we can get you hooked up on some of these sites. But basically, you have some really big property owners that are coming out now saying the Fed is really causing this real estate crash or potential real estate crash. And so you're starting to get some the Blackstones, the Starwoods, like these really big players that own a lot of property that have some political sway saying this is killing us. And so it'll be interesting to see how the Fed reacts to that. I mean, I think what we can hope for is that over the next couple of months, the Fed says, we think we've done our job, we're going to pause. And at that point, what I know about commercial real estate is it can operate in a high interest rate environment. It can operate in a low interest rate environment. Where it has trouble operating is when there's uncertainty. And that's where we've been for the last 12 months or so. It's like, if you knew the Fed was going to stop raising rates, well, then you can just start underwriting deals at the current rate environment. But when they've raised rates 400 basis points over the last 12 or 13 months, when you don't know how much faster or longer they're going to do that, you get really nervous about underwriting deals. And so I think if we have them come out and say, hey, we've met our intended result, we're going to just pause, I think the real estate market makes a pretty strong comeback.
In a recent episode, Timmy and I talked about ways to fund your first deal. And as part of that episode, we were talking about how commercial lending is a little different than what we're used to when we buy a house. And so we talked about balloon payments, and we talked about,
Amortization.
Yep, might be a 20-year amortization and a 5-year term. So you got this big balloon payment at the end of 5 years. And one of the things I've learned by listening to Treppwire is
25% of those loans are coming due.
Yeah.
Oh, look at that. Yeah.
Like, what's that going to do to the CMBS market? What's that going to do to the commercial real estate market in general?
It would be really, really bad if the lenders enforced everything that they were able to and told borrowers, your loan's due, you either make your balloon payment or we're taking the asset back because we're not refinancing you. But what we know is lenders are in the business of making loans. They're not in the business of managing or disposing of assets. And so if I'm a lender and I'm looking at this saying I could take this property back, but then I'm going to have to try to manage it and lease it up to get occupancy stabilized, or I'm going to have to sell it at 30 cents on the dollar, that's not appealing to me as a lender. If I could extend the term for 2 years, still collect interest payments from the borrower, and in 2 years, the market's in a better place, then the borrower hopefully will be able to pay the loan off. Or if I have to take it back then, the market will be more favorable for me to then dispose of the asset or lease it up. So like right now, nobody wants the bad assets, because whether you're in the commercial real estate space as a professional, you're having trouble managing occupancy and increasing NOI. If you're a lender and you're not even in that space, it's really, really daunting right now to think about that.
Lonnie, how have the bank failures of Silicon Valley Bank and Signature Bank, how has that affected the CMBS market in general?
It's brought a level of attention to, what banks' balance sheets look like, to, how if they had to mark their portfolio to market today, if they're sitting on unrealized loss.
You got to stop. You got to explain mark to market.
Sure.
So I'm just guessing that Timmy might not have ever heard that term.
Market to market?
Yeah, mark something to market. So basically, in a commercial real estate context, whenever an applicant comes in to get a loan, the lender will usually have an appraisal done at that time to determine what the value of the property is. And then they can use that value as a proxy, and they can say, if our loan is $80,000 and the property is worth $100,000, we have a loan to value of 80%, right? So they'll have lending guidelines that say we'll make loans on commercial. It's usually somewhere between 60 and 65% is like a preferred loan to value. But usually that snapshot of what is the value of this asset relative to the loan that we've made is only done at origination. As long as the loan pays and there's no issues, there's really no incentive for the lender to go out and get an updated valuation on the property. But with bank failures and with interest rates at 2x what they were at origination, a lot of times some of these assets that the lenders are currently holding, the values have diminished so much that the loan is actually more than what the current value of the asset is. So if they were to, so when I say mark to market, if they were actually to mark that loan balance to the current value of the property, in some cases the loan to value may be in excess of 100%, which again, I'm not great at math, but that's not where you want to be if you're on the loan side. And so in that instance, you could be sitting on what we would call an unrealized loss, where basically, the loan is $100,000, the property's only worth $60,000, and there's a $40,000 paper loss there. Now, if you go through to maturity, the market will recover, depending on how you look at it, and the property may come back and be worth way more than the loan. So you never incurred the loss, but on paper, it looks like you could if you were forced to sell. So there's been a whole bunch of stuff around hold to maturity and how banks categorize certain assets and all this stuff, which we never had talked about or heard about at all until a couple of months ago. And now all of those things are in the spotlight. So if you're a lender right now, you're just looking at making loans through a much more narrow scope. Things have to be premier property, strong debt service coverage, strong NOI, strong borrower, strong lease term, all those things have to be there for you to make a loan. Because if not, you're not taking on any increased risk right now with the regulators and everyone watching as closely as they are.
So what causes a bank to mark something to market? Is there a trigger that makes them do that?
The regulatory environment around banks is fluid. After the Great Financial Crisis, they created a bunch of testing with the Dodd-Frank Act that you guys probably have heard about. Timmy has not heard of that, but basically coming out of the Great Financial Crisis, the idea was coming out of that, we're going to put some testing in place so that never happens again. I think it's a moving target. We're going to see, my estimation would be that we see more regulation that comes out of this banking crisis. There's going to be more testing that's implemented on banks. And listen, like anytime that happens, that increases costs. It slows the process down, but it also hopefully ensures that that banks don't fail, which is not something we want to have happen in our country because that creates other issues downstream.
Yeah. Yep. That's right.
I'm glad you think so. Okay. So, Lonnie, most of our listeners are investors. They're users of space. So if you're talking to somebody in small town or just, the Midwest in general, they're not in one of these main primary markets and they own some apartment buildings and they might own an office building, not the big institutional investors, but, the mom and pops of the world that have built a real estate portfolio, they've built some wealth. What should they be doing right now?
So the first thing I would say is don't read too much into the headlines. Real estate by definition is a local and sometimes hyper-local business. And so just because there's some headlines that say this certain property class is in trouble doesn't by definition mean that your building and your location is in trouble. And so what I would say is, become an expert in your local market, talk to local lenders, talk to local brokers, get a feel for what's taking place in your local region, because those people that are actually doing that work every day in those locations are going to be able to give you a lot more granular insight into what's taking place there versus the national scene.
The loans that I have on the properties that we own are all at local banks. They're with people I'm friends with. There's definitely a relationship there. And if I got in trouble, like I'd be calling them right away. I was like, look, this is the situation that we're in. And I would expect that they would be very interested in coming to a solution that works for them and for us.
Yeah, like it being invited to the cookout.
Yeah, that's right. They might get more meal invitations.
And let me use your pool every other Sunday.
But I do have two questions based on what you just shared, Lonnie. One is, you've used the word covenant a couple times, but how would you define covenants?
An agreed upon expectation between the borrower and the lender. So it could be, just outlining what would happen in the event that someone misses a mortgage payment, or what would happen in the event that their debt service coverage ratio falls below a certain threshold. Debt service coverage ratio. So you take your NOI and you divide that over your annual mortgage payment, and that gives you what we call a coverage ratio. So like your covenants may say, if your debt service coverage falls below 1.25, then certain things are going to have to happen. We're going to start pulling the excess cash in and holding that into like a sweep account or something like that, so that the lender has some protection.
All right, my second question there is, like, I don't even know where I would go if I wanted to get CMBS financing.
It's not uncommon. There's a lot of people that make CMBS loans. There's a lot of people that's not their core business. A lot of lenders, like traditional lenders, and so you might not affiliate them with the CMBS market, but they do have a small, arm of or function of their lending platform that does offer CMBS.
I got a question. If I'm a borrower that wants to do a CMBS loan, how would you recommend I better understand my role in the covenant, right? Like fully understanding the covenant and knowing that there's not much flexibility to change it.
Yeah, so you would need to get an attorney on the front end that goes through those documents, that's familiar with CMBS structures, because you actually, as a borrower, do have the ability to negotiate some of those covenants, but they have to be negotiated on the front end. Once the deal's signed, that's where it becomes super rigid. But you could also subscribe to all of our free research and newsletters at Trepp. So we put out a blog, usually 3 to 4 blogs a week, research commentary. In fact, we have a series that we put out on our blog over the last couple of months called CMBS 101. So we've already put out part 1 and part 2 that kind of talk about the life cycle of a CMBS loan. And so as somebody like just trying to get a very preliminary understanding of that would be a really great place to start.
Awesome. Okay. Where can they go? They just go Treppwire.com?
Yeah, it's just www.trepp.com. And then we have a tab on there that says research and insights, and you can click on that. And all of our blog commentary or research papers, they're all free, and you can download those and leverage them to your benefit.
Awesome.
Yeah, we'll include that in the show notes. And then before we jump into the pop quiz, I want to know two things. One is, give us a feel for exactly what Trepp is, and how it serves the industry. And then where else can we find you online, or if somebody wanted to reach out and connect with you?
So Trepp is, by definition, a data modeling and analytics company. We were founded in 1979, and we've become synonymous with the CMBS marketplace. So if you are a bond trader, if you're a bond investor, if you're a CRE practitioner, you're using Trepp in some capacity, or you should be using Trepp in some capacity, because we have, a historical repository that goes back to those first issuance deals back in the 90s all the way to today. So what makes us unique is we're written into the reporting structure. So part of that loan covenant is that all of the loan data that gets supplied in the CMBS market gets passed through to Trepp. And that's because we provide transparency to the market for the bond investor side of the marketplace. But we can also use that data to help commercial real estate practitioners make more informed decisions. So what I mean by being written into the structure is every quarter, the properties that are financed with CMBS have to supply their financials to the lender. Well, those financials then get passed to Trepp. And so we have individual operating statement level income and expense data on every property in our data set going back to the 90s. And so if you want, SEC regulated, 100% accurate property level financials, we have the largest repository in the U.S. for sure. And so we provide that market transparency. We work with a lot of folks in the CRE landscape. And so, we've become a trusted source. Over the last month, we've been on CNBC, Wall Street Journal, American Banker, Reuters. You list any of the major news publications, Trepp is quoted almost daily in those. And so 43 years in business, we're pretty much a market standard at this point. So
now you've been on Commercially Speaking.
Yeah, so I will add that. I'll have to put that on the slide. We've been on Commercially Speaking, and so yeah, we also have a podcast ourselves. And so a little shameless plug. I'm on that podcast with two of my co-hosts, Martha Kocher and Manus Clancy, and we've been doing that for just over 3 years. We just had our 3-year anniversary. We're up to about 200 episodes, and it's really taken off. If you look at the last month with the banking crisis, last month we had 60,000 listens in 1 month. And so that's our high water mark for the month. We're almost at 1 million downloads overall. So it's become a really cool component of our job, because we basically tell market participants, what's taking place week to week in the markets as close to real time as you can. And so we really love this new outlet for kind of taking our data, research, analytics, and making it digestible for listeners. And so if anyone wants to connect with me, you can find me. I'm on LinkedIn. I'm on Twitter. Twitter handle is just Lonnie, LONNIE_CRE. Happy to connect on there. You can email me, find me on the Trepp.com website. And yeah, love to connect with folks. I'm a lifelong commercial real estate practitioner. I just happen to work in a data company now, but it's really great because now I get to work with folks that are still doing transactions, but I actually get to help turbocharge their efforts and make them more efficient, more productive. And it's really, really great. I love being at Trepp. It's a great place. And I think we provide some really great services to the community.
Yeah, and I'll tell you, every Friday morning, the new episode of the Treppwire Podcast, that's part of my morning routine on Friday mornings. I look forward to it, and it's a fantastic podcast. You and Manus and Martha, y'all do a great job.
Yeah,
it sounds a bit of inspiration for us trying to do a podcast as well. It's just been so informative to me. So thank you guys for doing that. I'm a huge fan.
Listen, there's enough room for everybody to be super successful in this space. So I love seeing you guys start this up and get some traction. And what I know is, like we mentioned, real estate is local and hyper local. Experience and expertise goes with that. So, you guys are boots on the ground. Timmy's next thing you know, I'm going to see him on some billboards somewhere selling commercial real estate, or maybe selling courses. He might be selling courses soon.
It's a very good chance to see my face selling Dintech mouth guards. That's in reality what my face is selling.
And that would be awesome. Yeah, we'll get you some traction on that. Yeah, but it's good. Everyone has a different perspective based on their market experience and based on where they're at geographically. And so I love the educational side of this for you guys, because look, if you're new to commercial real estate, we have our own language. It's our own CRE jargon. We have, acronyms and things that even if you've been in the business, it's tough to follow. And In certain markets, they quote rents on a per square foot per year basis. In some markets, they quote rent per square foot per month. Triple nets are quoted differently. Like there's all this nuance to our industry. And it's really great to have, folks like you guys putting some educational content out there saying like, hey, let's break this down so that everyone can understand how the market works.
Yeah. Okay.
All right. Well, Timmy, you ready for a pop quiz?
Let's do it.
Right.
Listener, can you beat me? I bet you can't.
Lonnie, as the college professor and our resident CMBS expert, what questions do you have for Timmy?
Well, I will say I saw Timmy taking notes, man. Like there was some smoke coming off the page there. He was writing so fast a few times. So let's start off with something pretty simple. What does CMBS stand for?
It's a great question. CMBS stands for commercial. See, commercials. I don't even know if I wrote that one down. Commercial mortgage-backed security.
Yeah, living good.
Is it? All right. It came. Nice. It came. That is actually not written down. It's looking. Surprised myself with that one. All right. Yeah, that was the easy one.
Yeah, that one was pretty easy. So let's go question 2. We said the commercial mortgage-backed security market stemmed from a crisis that happened in the late 80s. What was that crisis called?
Savings and loans crisis. Yeah.
2 for 2. Yeah, 2 for 2.
Every time we do this, he surprises me to no end that he pulls these answers out. Okay, keep going.
I'm surprised. Yeah, I don't give a shit about any of this information. You see? Right.
I think you're holding back on us, man. I think you've been selling stuff in the background. We just didn't know it. And you got a shadow CRE career somewhere.
You got me, Lunch.
Yeah. So let's go number 3 here. This one might be tough. We said one of the benefits of a CMBS loan as compared to a community bank loan was that it didn't require what from the borrower?
One of the benefits of a CMBS loan is that it doesn't require what from the lender? That
from the borrower.
From the borrower.
So as the borrower, there's a distinct benefit of a CMBS loan because it doesn't require that I sign a.
I mean, it's a fixed rate. It's typically 10 years over 30, 10 year.
Yeah.
Or 30. And.
We've never done it this way, but if you want to, phone a friend.
Oh, yeah. Oh, all right. Will you just ask me the question one more time?
Yeah, so there's a distinct advantage to a commercial mortgage-backed security loan that you wouldn't get from a community bank loan as a borrower. Because on a CMBS loan, you're not required to sign what?
I don't know. I don't know what it is. I don't know.
It's a...
I don't know.
Personal...
I don't know what it is.
It's a...
I don't know.
Personal
loan?
Guarantee.
Close.
Oh, personal guarantee. Oh, okay.
Yeah. So CMBS loans are non-recourse, so they don't require a personal guarantee. So that is enticing. If you're a borrower, one of the things that keeps you up at night is how much have I personally guaranteed from a loan perspective. And so that's something that makes some of those covenants and other restrictions a little bit more appealing.
So Timmy, what that means is if I go do a deal and I personally guarantee the loan of 3, 4, 5 million, and that deal goes south, the bank can go after my personal assets like my house where my kids sleep.
Gotcha.
Right. That's the extra layer of anxiety that you get when you sign a personal guarantee. Non-recourse means, man, if the deal goes bad, they just take the property, and that's it.
Yeah.
So you're not putting at risk all your other assets, and that's real nice.
Makes sense.
Yeah, I'm ready to lobby another one down the middle here. So we're going to get that average back up. So we said, from a lender's perspective, the minimum debt service coverage ratio that they're comfortable with was 1.25. There you go. Yeah. And so what does 1.25 actually mean?
That would be your net operating income over your annual mortgage payments.
Yeah. Tim's on fire, man.
Or for every $1.25 of net operating income you get, you keep 25 cents of it and you send $1 to the bank.
Yep.
That's right. So if it's
or the lender.
That's right. So if it's 125,000 in LY, and you've got 100,000 of your annual mortgage payment, then you've got $25,000 in your pocket. Is that right?
That is correct.
Yeah. Okay.
Yeah.
Yep.
Yeah. So, all right. So we're 4 for 5. So let's, or 3 for 4. Let's go 4 for 5. All right. Who is it that's causing a lot of the slowdown in issuance and just overall market transaction activity and velocity? There's a certain board that's responsible for that. Who is that?
Yeah. Well, the CRE market thinks it's the Federal Reserve. Elon Musk thinks it's the commercial real estate.
Yeah, so I think Federal Reserve is what I was going for, so you got that one. Elon Musk has an interesting take because he bought Twitter and they have a really large real estate exposure. And guess what? Like he went from, 7,500 employees to 2,000. So guess what they don't need a lot of? Real estate.
Right.
And so he's one of those more vocal power players that's really trying to put some pressure on the market because he's encumbered with a lot of long-term leases and really high rent payments that he doesn't want to have to continue to pay. So he has a personal interest in kind of creating his own narrative relative to the CRE landscape.
Gotcha. Yeah, because I asked Bo about this, I guess when I was in town, right? Like I saw this, what Elon Musk said, and I wasn't really that. I mean, that makes a lot of sense, Lonnie. What were you going to ask, Bo?
Well, it sounded like what Lonnie just shared was code for Elon's just trying to do things that benefit Elon.
I would say everyone probably tries to do things that benefit themselves. And I think for him, like if you just bought a company for crazy money and you cut your staff, you're trying to make it profitable. And it's not just Elon and Twitter, but if you look at Microsoft, Facebook, all these major tech companies have all slashed their real estate footprints and taken huge charge-offs against their real estate. And so a lot of them were way over-officed, millions of square feet of leases at $60, $80 a square foot. That adds up really, really quick in terms of how that affects your bottom line.
Yeah, one of those is in Chicago, Timmy. Salesforce is a major, and I think their headquarters is there in Chicago with you.
Yeah, I know where it's at.
Well, Timmy, great job, man.
4 to 5.
Man.
Let's go.
Yeah, you did great.
I'm impressed. I think you did great. You
Learned so fast.
Yeah, you're the man. If you ever need a job, let me know, man. We'll try to figure something out.
All right, let's go.
Get you in the CRE space.
You can't have him. You can't have him.